Welcome back. I hope you all had, I know it was only a very brief interlude, but I thought it was time that you had a brief interlude, grab a cup of tea, glass of water, because up next we have Egon von Greyerz. He is the founder and managing partner of Matterhorn Asset Management. And it's an asset management company based on wealth principles. Now, for those of you that were at our gold conference, when you could have a face-to-face gold conference, Egon was there. And he was a bit of a rock star at the time. Lots of people wanting to know his views on what was going to happen. And interestingly enough, what Egon said back in 2019, in my opinion, is starting to play out right now in terms of inflation, in terms of devaluation of currency. And last year, in fact, it was about this time last year, Egon, we had you on for the virtual gold conference where you said, and I quote, if you are not prepared, you will be eaten alive like Little Red Riding Hood. So welcome back to the virtual gold conference. Lovely to see you. And I love the Matterhorn in the background there. Let's start, Egon. For those that don't know who you are, they must be hiding under a rock. But anyway, can you just give a brief overview of what you've been doing and your involvement in the gold industry?
Yes, well, as you can tell, most people can tell I have a long career behind me. And hopefully quite a bit in front of me, which will be more exciting than the rest of my life put together, because a lot of things will happen in the world. But I started in banking in Switzerland and then corporate life in the UK. Then I decided that I wanted to do my own investment activities. So I started that in the 90s. And then at the end of the 90s, I saw that I didn't like the risks in the world. So we decided that we were going to look at ways of preserving wealth. So we found that obviously that gold was the best way to preserve wealth, physical gold outside the banking system. So we started with that for ourselves and the investors we advised at the time, and setting up a system for acquiring and storing gold in the safest places in the world. And obviously buying also and being able to trade gold. So that's what we did. In 2002, we went in a major way in gold, physical gold. That's when gold was in US dollars, $300. Then a few years later, about 3 years later, we opened it up for outside investors because there was a lot of demand, and that's what we've been doing ever since. We are, when it comes to high net worth and ultra high net worth and individuals, we are what I understand the biggest company in the world, and we have vaults in Switzerland, obviously, Rick, and we have vault in the Swiss Alps, which is the biggest private gold vault in the world, and ultra secure, real James Bond experience. And it's you should come one day and visit and have a look. Okay, it's really special.
I can't wait. One day when we are allowed out of the penal colony of Australia, I will be there. But it is, I've seen the video. It is very special. But you do have the biggest private gold vault in the world. What I want to know is, what did you see in the 90s? Because you just said you could see back in the 90s that things were not quite right. What could you see back then that we still aren't seeing today?
Well, this is basically, it was the Greenspan era, and Greenspan, like many central bankers, was an extremely wise man and understood risk until he became head of the Fed in '87. And then he started with the same policies as any government employee. I know it's a private bank, the Fed, but they're really cooperating with the government and taking orders from the government. Yeah. So he started the money printing in earnest and reducing interest rates to reacting to any situation like we had in the 90s, when there was early 90s, a lot of people had problems, especially in the property market, and a lot of property companies were going under. So rates came down, and they have been manipulated ever since. And so have, of course, the money printing started in earnest with Greenspan. And that continued in the 90s. And of course, derivatives were growing all the time. And that's always been my big fear. no derivatives today. I mean, they halve basically the amount by fiddling the figures. In the reporting of the BIS when they report total derivatives, but it is so they're reporting now 600 trillion. But it's a lot more than that, in my view. It's at least 1.5 quadrillion today. So
Wow.
those are risks that I saw, and then of course, but we only went in, as I said, to gold in 2002. But then we've seen the bottom in 99, 2000 at $250. And so when we bought, it was around $300, and we thought that this is the turn, and this also reflects the risks that we were seeing coming around in the world. And of course, gold started rising then, fortunately for us, and then a few years later, we had the 2006-9 crisis, massive money printing, and it's continued ever since. And gold then made a temporary top in 2011, 12, depending on the currency, then we had quite a few years of sideways move, depending again on the currency. It was between 3 and 5 years, depending on the currency. Nevertheless, it didn't change anything as far as I'm concerned. I have never changed my mind 1 second about the absolute essential protection of your wealth in the form of physical gold. So whatever the price was, we were never worried. We have the type of investors who don't look at price. They were not, our investors never phones us up to ask, what's happening in the gold market, why is it going down, or they don't write to us either about this. They're not worried because they know they actually understand the philosophy that we are preaching, which is you buy your gold, forget about the price, and you have it for wealth preservation purposes. Now, so gold in US dollars is still not past the 2011 top of $1,920. But we shouldn't look at gold in dollars only, because in Australian dollars, for example, gold is today about I think it's 37% above the 2011 top, for example, and it's the same in most other currencies except for in the US dollar.
You're right, actually. I actually hadn't thought about that, but you're right. In 2011, we were on parity with the US dollar, and I think the top for us in the gold terms was 1911. And you're right, today it's 2,500.
Yeah, exactly. So that's I calculated just before our chat. So I think it's 37% above right now, 37% above the 2011 top in Australian dollars, and it's similar in euros, it's in pounds, in Canadian dollars, etc. It's just that we've seen an artificially strong dollar, which isn't justified at all. The dollar is in a continuous downtrend since 1971. You take, for example, against our currency, the Swiss franc, the dollar has gone down 80% since 1971. Few people understand that. And of course, most Americans don't have a passport, so they don't even see what's happening to their currency. Because they can travel within their vast country. They don't need to go abroad. But nevertheless, if they come to Switzerland, they pay, their currency has lost 80%. Yeah. But yeah. For us Swiss going to America, of course, it's very cheap. It's 80% cheaper. So works both ways. What I'm saying is, don't look at gold. Don't measure gold in your currency, whatever it is. If it's dollars, it's okay. So you made less right now. If you're looking at a gain, which you shouldn't, because it's wealth preservation here, not actually short-term gains. But gold is basically in a continuous uptrend since 1971, of course, and then with a big break between 1980 and 2000, basically. And now, in the last, if you look at even in dollars, in the last 21 years since 2000, gold has gone up 17 straight years out of 21. So that it's if you look at an annual chart of gold, even in US dollars, it's an amazing uptrend. But we should turn the chart around, of course. It's not actually an uptrend at all in gold. It's just that the currencies are losing massive amount of money. And that hasn't, in my view, we have, since we started as a company, we're seeing, which obviously continues major inflows into wealth preservation gold that we are representing. But we're saying that hasn't started yet. The real move in gold hasn't started yet. And that's still to come, because nobody is in gold, as we both know. Nobody. 0.5% of world financial assets are in gold. There's absolutely nothing. It's laughable. And you just take, okay, so a lot of individuals would come in, a lot of opportunities will come in, first of all, and it goes up. But then also, but a lot of wealthy people, or more wealthy people, will come into gold. Normal people will come into gold, because some of that partly, of course, for speculative purposes, but hopefully for wealth preservation purposes, which is what is important.
But Egon, do you think the majority of people even understand the wealth preservation an analogy? Because I look at people and it's the wealth effect, the property market's going up, the share market's going up. They feel more wealthy. What they don't see is that inflation is rearing its ugly head, not transitory, it's here. But I see that people don't focus on gold because they're seeing that wealth effect in other asset classes.
No, you're absolutely right. I mean, to be an investor or to be an asset manager in the last 20 years, or you can even say the last 50 years, I mean, it's been the easiest game in the world. Everything you touch went up. And every time the market crashed, whether that was in 87 or whether that was or again, early 90s, and then in 2000, and then in 2008, 9, and a year ago again, every time market crashed between 40, 50, and 70%, it came straight back. It's worked. What the central banks have done has worked short term. They have flooded the markets with money. Not just central banks, but of course bank lending also, which is the biggest part of credit expansion, if you want. And it's worked, and people don't realize, as you say, that is actually totally reflected in the currency. If you look at the currency against real purchasing power, that is gold. So we're down 97 to 99% in all currencies against gold since 71. And since 2000, we're down 80 to 85% in all currencies. Since 2000, gold has been an incredible performer this year. Sure, people who want to prove us wrong will take gold in US dollars from 2011. And look, we haven't made any money.
Yeah.
But that's sure. You can always start at the worst point ever, and then to prove a point. But really, just look at the long-term chart. Look at the chart from 71. Then, if you don't like starting at 2000, which was the corrective bottom of gold since 1980. So whatever long-term period you look at, gold is, as I said, not going up at all on a chart if you measure it against any paper money, which is being destroyed by the day. Of course, it looks like it's going up, but you turn the chart upside down and it tells you what your currency is losing. And that's what it's all about. Remember, gold isn't an investment. No. It's just preservation of purchasing power over time. That's all it is.
And I think that's what we've got to look at. That a lot of people say, how do I invest in gold? You're not investing in gold. You invest in other asset classes, but gold, as you rightly say, is a wealth preservation tool. How do you think people should look at it in that way? If people are saying, well, I like to see the numbers going up and I don't see gold as increasing the wealth effect for me, what would you suggest to those people to get their head around this? Because I think that the majority of people, all they're looking for is investment. What you're saying is very different. It's wealth preservation in a world which is printing funny money like it's going out of fashion.
Sadly, the psychology of savers and psychology of investors is that they follow whatever is written in mainstream media, press, television, what's happening in the stock market. If the stock market goes up or if Bitcoin goes up, they are totally in favor of those areas of investment, and they don't even look at anything else. If you want to be a successful investor, never mind also talk about wealth preservation and risk, but even as a successful investor, you don't buy when the papers talk about it. You don't buy when after it's gone up considerably. You look at a stock like Warren Buffett did, or still does, or you look at an asset class, and you say to yourself, is this undervalued and unloved, and is this likely to rise in the longer term? So that's what we did with gold in 2000, around 2000, but then timing wise, we went in at the beginning of 2002 into gold, because gold was incredibly unloved and undervalued. I have shown in some of my articles, or many of them actually, it's a graph that I often include in an article, which is, excuse me, I've got to drink a piece of water.
I'll take some too. Cheers.
Cheers. I show a graph of the gold price in relation to the US money supply over time. And that graph shows that gold today at near 1900 US dollars is as cheap as it was in 71 at $35 and in 2000 at $300 in relation to US money supply. And remember, the gold price basically reflects the destruction of paper money. So if you print more money, the money supply goes up, then gold will reflect that. But gold hasn't reflected all the credit expansion that we have seen today. So, and the interesting thing is, even gold today is as cheap as it was in 2000 at $300, or in 71 at $35 in relation to the amount of money being created.
Okay.
And therefore, gold, even if people say, "Oh, you were lucky you bought gold at $300 in 2002," yes, but look at now. Gold is again as underloved or unloved and undervalued as it was in 2002. So the opportunity is still here today for gold holders. So to invest in gold. So therefore, gold is still an amazing opportunity, and especially bearing in mind looking at what I expect to happen in the next few years. Now, things have taken longer than I expected when it comes to the world financial system surviving in the way it has on totally empty or worthless money. It is quite amazing that investors, you ask about investors, we're coming back to that, what they should think about. But what they should think about is that all the asset classes that have now gone up dramatically, stocks, property, bonds, etc., it's nothing to do with real money. It's got to do with money that has been created out of absolutely nothing, out of thin air, and just pressing a button on a computer. And that money, billions or trillions, are just being set in production, and then reaching the ones who stand nearest the till, which is mainly the big investors, because the people never get that money until it's worthless.
Absolutely.
Going down in value.
You said a while ago in one of your previous chats that the system should have collapsed in 2006, but it didn't. Could the same happen in 2026? It should have collapsed, but it didn't. Could this play out for a lot longer, and therefore, I guess the preservation of wealth in gold continues to be something that people don't focus on? And I guess the question I'm asking is, if it should have collapsed in 2006, why didn't it? And perhaps it never will.
Yes, it's a good point. And of course, what you learn through a long life of experiences is that even if you see something very clearly and you see a risk being totally unacceptable, as I saw already 20 years ago, things don't always happen as quickly as you believe. And partly I think that is because we are at the end of a major era now, a very big cycle. Only future historians will be able to tell us if that is a 300-year cycle or if it's a 2,000-year cycle. And as I said, we will see the beginning of the turn when it happens. But I'm unlikely to see the end because it's going to take a long time once it turns. Remember, even in 29, the US stock market peaked at just under 400, the Dow. Then it crashed into 32, and then it took 25 years for the Dow to come back to the level where it was in 1929. So, markets don't always come back, and they don't always come back in a month like they did last year. People have been spoiled because the generation that is living and investing today have only seen markets going up, and that's why we come back to your question. So, what should we point at for these people to understand what the risk is? Well, sadly, I think most people will only react to the risk when it's in the press, when they see disasters happening in the financial world or in corporate world, or when they see banks going under, or when they see gold going up dramatically and the dollar, US dollar collapsing. That's when they will start reacting. They won't. Nobody, as I started this part of with. Nobody looks at it at an investment or when it's unloved and undervalued, because it's not on their horizon. Nobody talks about it. Nobody talks about gold. You might get every now and then, even now, you might get in the paper say gold is going up because of the Fed did this or the Fed did that. But that's not what the Fed does. Doesn't matter at all long term for us. Long-term investors. It has got no bearing. The trend is clear. We know the trend. As I said, we can look at a 50-year chart of gold, or we can look at a 20-year chart of gold. The uptrend is tremendously strong, and it's not due to gold. It's due to the destruction of paper money and the value, which is going down. And that, in my view, the crisis started in 69, the last phase of this crisis. It was temporarily saved by massive money printing, and we got another wave now of printing. Remember, in 2000, global debt was 100 trillion. Today is 300 trillion.
Yeah. Yeah.
So that's why, why is it not going to continue? Well, you're getting a diminishing return on your printed money. That's why basically now you've got to print many times. For every dollar of GDP, you've got to print $3 of money or $4, depending on the country. So you've got to print more and more. So that basically, which is obvious, because if you're printing money that has zero value, except for you attribute a value to it because you say this is the same as the old dollars or the old euros. It isn't at all, of course, because if you double money supply, you halve the value of a currency in theory. And therefore, the money is being destroyed the whole time. And this is what investors should focus on. Now, don't wait until something becomes expensive to buy it. Buy it when nobody wants it. And that's the case with gold, and of course, even more so with silver. Silver is incredibly cheap.
Yeah.
Incredibly cheap.
Two things I want to ask you. Let's go to silver first, and then I want to talk about inflation, and then last comments to you about our audience. What should they do? What percentage? So let's talk silver. What do you like about silver, Egon?
Well, it's the most undervalued and unloved commodity, or I don't like it to call it commodity even, because that has a connotation that is a speculative investment. But I would say asset. It's the most undervalued asset there is. I mean, I've had, you say it's an arbitrary level, but nevertheless, gold will certainly, I've always said that gold will at least reach 10,000 in today's money. but today's money is deteriorating all the time. So 10,000 is just psychological point, not a real projection. But that will certainly happen. But even if gold only, I think it will be so much money printed, so that 10,000 is a useless figure, really, because it depends on how many dollars or euros are printed. But let's just take 10,000 in today's money. That we will achieve that, at least in gold. So if the gold-silver ratio returns to its historical level of 15, that is, gold is 15 times the value of silver,
yep.
Or the price of silver, then of course at 10,000 that will give us a silver price of 666. Some people don't like the figure 666, but I think this means a lucky figure. So so I think this is what we're talking about, silver in the hundreds of dollars at some point. And that's even in more or less today's money. If we get inflation or hyperinflation, you can name a figure. It doesn't matter, because it doesn't mean anything to have a silver worth 100 trillion or whatever with hyperinflation. So, but what I'm saying is, silver is relatively going to go up, say 3 times as fast as gold. But we've always told our investors, from a wealth preservation point of view, you should have less silver than gold, a lot less. We've said maybe maximum a quarter silver and 3/4 gold, for the simple reason that it is so volatile. And we've been right so far. The volatility since even since 2000 has been dramatic, of course. Mm-hmm. Started with silver at $4 and went up to $21 and then down to $7, $8 and then up to 50 and then down to the low teens again. So it's been incredible volatility. And if you want to sleep well at night, you don't put all your money into silver. Because it is more speculative and more volatile. But nevertheless, I think to say put 3/4 of your money into gold, your wealth preservation money, and 1/4 into silver, I think that's responsible. And silver will give you a dramatic opportunity. But remember, again, we're not doing this to make money. We're doing it to preserve wealth.
And now, I think today, yeah.
I think.
Go ahead.
Can I just say, I think both gold and silver will not just preserve wealth. I think you will enhance your wealth also, because I think we will have goldomania, and we could even have silveromania, we will have silveromania, even more so actually. For the simple reason that when the world sees what's happening, there will be a stampede. There's no question about it. There will be a stampede into the metals. And like all stampedes, it will go further than it should. So gold and silver will become overvalued and overloved at some point in the next few years, 5 years, 7 years, whatever it is. And of course, at that point, you look at the financial system and say, has it been restructured? Is it looking safer? Or you look at the world and say, is land become incredibly cheap, or the properties cheap, or can you buy companies for virtually nothing in gold or silver terms? And then, of course, at that point, when it becomes overvalued, you will obviously swap some of your gold or silver for other investments. But that's a long way away. Don't worry about that now. Worry about first preserving your wealth, because if you don't, you're going to see in real terms, i.e. in relation to gold or silver, you're going to see your assets crash dramatically.
There you heard it from Egon von Greyerz himself. You have to have exposure to gold and silver because asset values may decline in the coming years. So it's just a sensible wealth preservation. It's not about investing, it's wealth preservation. Egon von Greyerz, I think we're going to have to do part 2 on my Gold News channel in the near future. Today, we've only got a short period of time, but I'm so grateful for your time and great to see you again with the Matterhorn in the background there. And hopefully one day we'll see each other in person again.
I hope so too. I mean, it's always wonderful to talk to you, and my greetings to all the wonderful Australians who come to your conferences, and I love being there. It's such a friendly environment. Really is nice to come and see you all.
Well, we'll get you back one day, but on the line today, we've got people from all over the world. We appreciate you very much, Egon, and we'll speak to you again very soon. Thanks for joining me.
Thanks so much, Carrie. Thank you.